Navigating the fiscal seas. The Federal Reserve's impact on fixed income investments. In the realm of financial markets, the Federal Reserve's stance on interest rates casts a profound and far-reaching shadow, particularly for investors navigating the waters of fixed income securities. As the steward of monetary policy in the United States, the Federal Reserve wields the power to influence interest rates, sending ripples through the bond market and shaping the landscape for fixed income investments. Understanding the intricate dance between the Federal Reserve and fixed income investments requires peeling back the layers of economic dynamics, policy decisions, and market reactions. The Federal Reserve's dual mandate. The Federal Reserve, often referred to as the Fed, operates with a dual mandate to foster maximum employment and stable prices. In pursuit of these objectives, the Fed employs various tools, one of the most potent being the manipulation of short-term interest rates. The federal funds rate, the interest rate at which banks lend to each other overnight, serves as a key lever for the Fed to achieve its goals. Changes in the federal funds rate reverberate through the broader economy, impacting borrowing costs, spending, and, crucially, fixed income investments. Interest rate movements and bond prices. The relationship between interest rates and bond prices is akin to a seesaw, with an inverse correlation that lies at the heart of fixed income dynamics. When the Federal Reserve adopts a hawkish stance, signaling an intention to raise interest rates, the prices of existing bonds tend to fall. This phenomenon, known as interest rate risk, stems from the fact that newly issued bonds carry higher coupon rates in response to the increased cost of borrowing. Consequently, older bonds with lower coupon rates become less attractive in the secondary market, causing their prices to decline. Conversely, when the Federal Reserve adopts a dovish stance, signaling a commitment to lower interest rates or accommodative monetary policy, bond prices tend to rise. As the cost of borrowing decreases, the market value of existing bonds with higher coupon rates becomes more appealing. Investors holding these bonds may experience capital gains as the prices rise in response to the lower prevailing interest rates. Yield curve dynamics. The yield curve, a graphical representation of interest rates across different maturities, serves as a valuable barometer for fixed income investors. The Federal Reserve's influence on short-term interest rates can alter the shape of the yield curve, presenting opportunities and challenges for investors seeking to optimize their fixed income portfolios. In a rising interest rate environment, the yield curve may steepen as short-term rates climb more rapidly than long-term rates. This scenario can create headwinds for fixed income investors holding longer-dated bonds, as the prices of these securities may experience more significant declines. Conversely, in a falling interest rate environment, the yield curve may flatten or invert, potentially benefiting investors in longer-dated bonds as their prices appreciate. Credit spreads and risk appetite. The Federal Reserve's stance on interest rates also influences credit spreads, the additional yield demanded by investors to hold bonds with higher credit risk. When the Fed signals a tightening of monetary policy, investors may become more risk-averse, demanding higher compensation for taking on credit risk. This dynamic can result in an expansion of credit spreads, affecting fixed income securities with lower credit ratings more profoundly. Conversely, a dovish stance from the Federal Reserve may encourage investors to embrace higher-yielding, riskier fixed income assets, compressing credit spreads. In such an environment, investors may seek out higher returns in the pursuit of yield, potentially favoring corporate bonds or emerging market debt. Duration management and interest rate sensitivity. fixed-income investors must carefully manage the duration of their portfolios in response to the Federal Reserve's interest rate stance. Duration, a measure of a bond's sensitivity to interest rate changes, becomes a crucial consideration. In a rising interest rate environment, investors may opt for shorter duration bonds to mitigate the impact of interest rate risk. Conversely, in a falling rate environment, longer duration bonds may be favored to capture potential price appreciation. The Fed's forward guidance. Beyond actual interest rate movements, the Federal Reserve's forward guidance plays a pivotal role in shaping fixed-income investment strategies. The central bank communicates its intentions and economic outlook through statements, press conferences, and policy announcements, providing investors with valuable insights into future interest rate trajectories. For instance, if the Federal Reserve signals a commitment to keeping interest rates low for an extended period, investors may adjust their fixed income allocations to capitalize on the favorable rate environment. Conversely, hints of an imminent rate hike may prompt investors to reassess their portfolios, adjusting duration and credit exposure to align with the evolving interest rate landscape. Global implications in currency markets. The Federal Reserve's decisions on interest rates reverberate beyond U.S. borders, impacting global fixed-income markets and currency dynamics. Changes in U.S. interest rates can attract or repel international investors seeking yield or safety. A rising interest rate environment in the U.S. may lead to capital outflows from emerging markets, as investors flock to the relatively higher yields offered by U.S. assets. Conversely, a dovish stance from the Federal Reserve may weaken the U.S. dollar, potentially benefiting international fixed-income investors as the value of their dollar-denominated holdings appreciates. The interconnected nature of global financial markets underscores the importance of considering the Federal Reserve's impact on fixed-income investments within a broader international context. Conclusion. In the intricate tapestry of fixed-income investing, the Federal Reserve emerges as a central protagonist, shaping the narrative through its decisions on interest rates and monetary policy. As investors navigate the ever-changing currents of the bond market, a keen understanding of the Fed's stance becomes indispensable. Fixed-income investors, armed with insights into interest rate dynamics, duration management, and global implications, can navigate the fiscal seas with greater clarity and adaptability. The Federal Reserve's influence extends beyond mere interest rate adjustments. It weaves a narrative that resonates through bond markets, influencing investment strategies and portfolio outcomes in a dynamic and interconnected financial landscape.